Financial Literacy Week powered by U Mortgage. It is a pleasure to see you here again. For those of you joining into the room, you'll see that your microphones and cameras are turned off intentionally for joining this webinar. We encourage you to participate as much as possible in this session, and you can do so by using either the chat feature. In the bottom tab, you'll see those tools. You have chat, and you also have Q&A available to you. So as Matt, our guest speaker today, is going through his presentation, you'll be able to ask questions, and we highly encourage that you do so. It's a pleasure to introduce Matt Gauget, one of the top mortgage brokers in California, to host our session here in Financial Literacy Week and partner with us. And he's going to be speaking about refinancing. So welcome, Matt. How's your day going? Oh, Matt, I think you're muted.
All right. It's going great. Thanks for having me. Glad we got that out of the way. No longer muted. Matt Gauget, mortgage broker out in California with U Mortgage. Super excited to be with you here today. I think that refinancing is a really important topic, especially in 2022, especially as mortgage rates have gone up. I'm seeing a lot of stuff going on in the mortgage industry that, to be completely frank, I don't like. You know, there are certain times where refinance is a huge benefit. It makes a lot of sense. There's other times where it just flat out does not. Some of the loans being written, I'm just going to use the word predatory, right? So in today's session, I want to go over some pros and cons of refinancing, some myths of refinancing, the different types of refinance, what you should and shouldn't be doing, because, you know, we all know, anybody who's in the housing industry knows and understands, you can build generational wealth by being a homeowner. That's why it's so exciting to get somebody into a home. As you're building this wealth, as the home is increasing in value and you're paying down the debt on the home, the last thing you want to do is make a bad decision when it comes to refinance that's going to set you back years, tens of thousands of dollars. So that's enough of an intro. Reminding everybody that I'm a loan officer, I'm a licensed loan officer, but I'm not a financial advisor. I tell folks I'm just some guy on YouTube. Go check out the YouTube channel, Matt the Mortgage Guy. I've got 600 plus videos there. I'm all about financial education to consumers. That's what the channel is mostly about in regards to mortgage and real estate and some general finance, to be completely honest. So, you know, if you want, you know, specific financial advice, you know, and you've got a financial advisor, speak with them. I'm going to be speaking today on refinance in particular, because it's my area of expertise. So with that out of the way, let's just jump right in. We've got refinancing as our topic, Financial Literacy Week at U Mortgage. If you haven't already, I encourage you to check out other sessions. We've got a couple dozen. We've got some replays this weekend. Lots of good stuff packed in. It's the best price on the market. It's free. Go get yourself some financial literacy in any area you're looking to improve on, right? There's some stuff on investment properties. There's some stuff as a first-time home buyer. There's some stuff on cryptocurrencies and NFTs, all kinds of great stuff. I popped in and checked out some other sessions, really good stuff. So as a consumer, take advantage that there's such good information online nowadays, and go check out some of the other ones we got. So goals of this session, really, I just want people to recognize different refinance considerations. Some good, some bad, some make sense, some don't, right? I'm going to be completely straightforward. That's how I run my business. I'm not a salesperson. I'm merely an advisor when it comes to advising you on your debt, on your largest asset for most people, which is your home, right? I'm going to explain the components of a loan estimate. A loan estimate is the document that shows all the numbers on your refinance. A lot of people are shown different things from different lenders for different reasons. That's a nice way for me to put it, right? A lot of smoke and mirrors out there. I'm going to teach you how to read a loan estimate, exactly what every piece means, and how you should be looking at it, the important parts to look at, namely box A, where the lender controls the fees. Some lenders are going to charge you an arm and a leg, knowing that you'll look past it if you see a nice low interest rate, right? And a low interest rate with an abnormal amount of fees is not the best financial decision. We'll get into that later. I'm going to describe the difference between refinance and Heloc, which is home equity line of credit. The home equity line of credit is something that's really popular in 2022, as you can imagine, because people have a lot of equity in their house. It's just another way to get access to this equity. there's cash out refinance, and there's home equity line of credit. I'll kind of explain the differences and the pros and cons of both. And then finally, I'll debunk some refinance myths. There's a bunch of myths out there that just aren't true. And if you look hard enough on the internet, you'll find all this bad info, right? So let's jump into it. Let's share some good info. First question folks ask themselves, or they ask me, or ask somebody on my team, is should I refinance? Should I refinance is a very broad question to a very specific scenario. Everybody's scenario is different. You have to look at yours, look at all the factors that go into it, and then we can make a decision. What happens more often than not when I'm talking to folks, they don't have a yes or no answer to this question, should I refinance? Truth be told, in the first 30 seconds of talking to them or looking at their statement, I don't know the answer either. But collectively, as we have a conversation around it, we get out the goals, we get out the budget, we get out the options. That's where we decide, okay, this makes sense or it doesn't. So with that in mind, I think the very first piece that people should be thinking about, and I don't think enough of them do when they're considering refinance, right? Everybody's refinancing. My neighbors are refinancing. My cousin refinanced. I heard rates are low. I should be refinancing. That's what they hear. So they call somebody, hey, I'm thinking about refinancing. Here's something to ask yourself and to get clear on before you even make a phone call, I believe, is to know your budget. I would be interested to hear from anybody, and this will be, where we have some participation from the crowd. Do you know your budget, and specifically your housing budget? Is $1,500 a month what you can afford from a monthly perspective for housing? Is it $1,800? Is it $2,000? Some people know and some don't. So when I talk to you and we're talking about paying off credit cards, or we're talking about pulling out money to buy an investment property, or whatever the different conversations around refinance might lead to, you have to know first, if we do a cash out refinance and your new payment is $2,350 and you've been used to paying $1,800 and $2,350 would be a stretch, it would leave you stressed out, it would leave you short every month, you'd go into credit card debt, then that's likely not a path we're going to walk down, right? But first, you need to know your budget. So if nobody has that, right now, we can circle back with that. Know your budget, right? All right, where are we at next? Whoops, skip that one. Two different types of refinance that are most common, either a cash out or a rate and term. And quite simply put, you do a cash out refinance, it means you're pulling equity out of your home. You currently owe $200. You're going to pull out some cash, and now you owe $250. Whether, no matter what that cash goes to, debt pay down, fixing up your house, investing in something different, that's a cash out refinance. A rate and term refinance is simply taking the rate and the term you're paying. Maybe you started at a 5.25% and you were on a 30-year fixed, and that thing is 9 years old. So you've got 21 years left on this 5.25. Well, if you refinanced it to a 2.875 15-year loan, you're changing the rate, you're changing the term. And for some people who have been in a loan for 5, 7, 8, 12 years, they might want to look into a refinance that shortens their term. If you've got 21 years left, you've got 17 years left, and you can lower the rate, you might be able to lower that rate and lower how long it's going to take to pay it off, and your payment might even come down, right? So cash out or rate and term, know what you're looking for, and go from there. The considerations for cash out, a lot of folks, they come to me as a mortgage loan officer, or they're out there poking around, asking questions online. I've got a lot of equity in my house. I want to do a cash out. Fair enough, but why? Is it just because you have equity? And people talk about, I want to unlock the equity. I want to use this equity. It could be a good idea in an environment where inflation is 8%. It probably is, as long as that money goes towards something useful, an investment that's going to yield 12%, the payoff of debts that are currently 18 or 20%. but you got to know where it's going to go, right? So have a plan for the money. I think that when I talk about home equity line versus cash out refinance, where the money's going, how fast it's going to be deployed, and how fast it's going to be paid back are important considerations for that home equity line analysis, home equity line versus cash out refinance. Okay, in regards to a rate and term refinance, I'll talk about this one first. To me, it's really, really simple. And I did hundreds of these along with every other loan officer, I think, in America over 2020 and 2021, a rate and term refinance where, truth be told, there was so many people, almost everybody that could benefit from a rate and term refinance. And I had conversations galore. People didn't really even understand what they should be looking at, how they should be looking at it, from like whether or not it makes sense. And I can tell you the cost versus benefit analysis is one of the simplest things to do. And if you're working with somebody who's a straightforward, honest mortgage broker, this is exactly how they're going to break it down for you. How much do you pay now? What does the new payment look like? And how much does it cost? We'll get into real detail on the loan estimate. You've got some prepaids of taxes and insurance and other things. But purely from a total loan cost perspective, if you've got $2,825 in total loan costs, these aren't, prepaying your property taxes or homeowners. That's all stuff that's going to be paid regardless. True costs of the loan versus the benefit, you can do this analysis that says, I'm going to save $200 a month. If it costs me roughly $2,800 to do this thing, it's about a 14-month break even. And the conversations we had were, do you plan to stay in this house for the next couple of years at least? Well, sure. I see us here at least 5 years. All right. Well, doing a refinance that's basically going to pay for itself within 14 months makes sense all day, every day. And trust me, 2020, 2021, going from 4% to 2.75 or from 4.25 to 2.625, whatever the case may be, people saw the benefit in rate and term refinance, and it was easy, right? 10-month break even, 12-month break even, 15-month break even. There's no hard and fast rule for how quick of a break even you need for it to make sense. But I would say if the break even is more than 3 years, you might want to reconsider, right? Under 3 years, and you're going to stay there, that one probably is justified. All right, so a really important part of this, and if anybody has any questions come up, please feel free to reach out. If you have questions that come up and you're watching this on a replay, me and my team are more than happy to help. Go to greatmortgagebroker.com, fill out the quick form, let us know where you're at, how we can help. This is a section I think should be valuable to most anybody, whether you're looking at refinance, whether you're looking at purchase, doing anything in mortgage. This loan estimate is a form all lenders have to use. It's used on refinance, it's used on purchase, it's used by big banks, it's used by mortgage brokers, it's used by direct lenders. Everybody uses this. It's the standard form. So let's go through it. Let me answer some questions, some things you really want to look at. You'll get an initial disclosure package that has 80 pages in it, a bunch of fluff. The 2 or 3 page loan estimate, those are the pages you want to look at, right? Okay, so let's jump into it. We're going to look at lender controlled fees, and figure out how do you compare loan estimates.
Hey, man, a question did pop up. Somebody asked, they've heard a rumor that it can be bad to shop around for a refinance. Is that true?
That's definitely not true. And I think that, there can be a case made for too much shopping is a bad thing. But getting a second opinion from somebody you like and trust is always a good thing. And I'll give you a couple examples literally from today. I've got a client who reached out and said, hey, this is a weird thing with a solar lien and they're structuring my loan in a weird way. And we had this client pre-approved. He had gone off and talked to somebody and for whatever reason, I think it might have been that the realtor had a relationship with this lender, moved forward with this other lender. In this case, I think the client felt like he was shopping. I looked at the loan estimate And I didn't want to make this client feel bad, but literally paid a half a point higher and 3,000 or 4,000 more in fees than what we could have done for them. And in that case, I think it's, consumers might not understand my estimate on February 4th, somebody else's estimate on February 13th, another lender's estimate on February 27th. In a market like this where it's moving as fast as it is, to compare apples to apples, you got to compare the same day. It changes every single day. Another thing to take into consideration is, in a competitive market like we have, lenders might be, providing you with one estimate that looks good. You're trying to compare it to, you're going to compare oranges and apples and pears and try to figure out which one is best, right? I'm going to show you through this little exercise how to look at a loan estimate and truly see, like, rate and lender controlled fees, who's better, right? You certainly want to shop. I think that, too much shopping might make your head spin, but talk to, a local mortgage broker, talk to maybe where you bank at. That's tough if you're buying because most of them can't perform on the tight timelines for buying a home. But, maybe you get a referral from your realtor, then you find somebody local who's got a good reputation online or something, right? Just to make sure that's in the ballpark. There's other stuff you can do as a consumer too, like you can go to Mortgage News Daily, click on 30-year interest rate. You can go to the CFPB's website and you can look at like what the average rate is for your city, your credit score, your down payment. And so that stuff might help as well. But it's tough out there. Shopping, yes, and I tell people to come, go to greatmortgagebroker.com, fill out a form, let us review what you've got. The problem I see is that 9 times out of 10, you might be talking to a salesperson, right? You come to me and I'm just going to tell you, hey, apples to apples, this is what they got, this is what we got. Better or worse, whatever the case, as a broker with low margins, I know that we're going to be very competitive on price and rarely lose there. But those that aren't are going to find interesting ways to try to create the illusion of a good deal. So a couple of things to look at on this loan estimate. And this is something, if you're not being shown a loan estimate, which, until you have initial disclosures, it might not be this. We have an Excel spreadsheet that mirrors a loan estimate. So we could show somebody in this format what their loan's going to look like. Some people tell me, oh, I've got this loan with so-and-so and I've got this specific interest rate. Well, this first box that I have an arrow pointing to in the upper right says rate lock and it's checked yes. If you have an interest rate quote and this is checked no, then you don't really have anything, because an unlocked loan is not very, it doesn't mean anything, right? I think there's a big rocket ship type lender that's pretty known for sending out loan estimates with a great interest rate. They are not required by law for whatever reason to disclose all the fees if the rate is not locked. So it'll say not locked. When you do lock with them, then all of a sudden a bunch of fees are going to show up in box A, but we'll show you what box A means later. This first box here is going to show your loan terms, your loan amount, your interest rate, the monthly principal and interest payment. That's all here on the first page of the loan estimate right up top. Pretty straightforward. And then projected payments. If you had mortgage insurance, it would show up there below the principal and interest. Estimated escrow, which is your taxes and insurance, is there. And it'll even tell you below, are these things in escrow? Meaning, do you pay all one payment to the mortgage company and they pay your tax and insurance for you? In this case, it's yes. And so that $547 is included. $1,776 is the total payment for this borrower. And then at the bottom of that first page of the loan estimate is this that says estimated closing costs, estimated cash to close. This loan estimate I'm looking at is for a refinance. And I want to remind folks, they're going to see estimated closing costs and they're going to say, oh my gosh, $7,680. That is a big number. There's $7,600 in closing costs. Well, no, there's $2,137 in true loan costs. There's $5,543 in other costs. On page 2, we'll break down those costs, but you shouldn't be factoring in prepaid tax and insurance when you're trying to figure out if a refinance makes sense. Whether it's paid by your current mortgage company, the future mortgage company, you separate from the transaction altogether, those costs, tax and insurance, are something that are going to be paid regardless, right? So just because they're here doesn't mean it's added. Loan costs are $2,137 in this case. This borrower got a sweet deal. Estimated cash to close. This says $19. Let's say that you were getting a cash out of $40,000. That would appear here, and then you look over here, and you find out if it's from the borrower or to the borrower. To the borrower, meaning cash back to you, $19 in this case, $40,000, $50,000 in a cash out. If it says from, you've got cash to close, and that's what it's going to look like on a purchase deal. This is going to say $33,722 from the borrower. Okay, let's move on to page 2 of the loan estimate. This is the very top left of page 2 of a loan estimate, probably the most important box. And a real quick thing on refinance. I made a video, again, YouTube, Matt the Mortgage Guy, comparing loans, apples to apples, how to compare refinance. I don't remember the title of the video, but this box A of a loan estimate is the only thing that's controlled by a lender. Only thing. All the other things, the title fees, the appraisal fee, prepaying taxes and insurance, all of that stuff is third party and 100% out of our control. What we do control is box A. In this scenario, for this loan, we've got nothing in box A. There's no dollar figures here, right? We're not charging this borrower anything. When you saw that $2,100 in loan costs, that came from, let me get through this one, right above, title fees, the appraisal, and this stuff right in here, right? So title and appraisal, $2,100 total, and then the other costs, the $5,000 or so, prepaying property taxes, prepaying interest, prepaying a few months of homeowners insurance, and a few months of property taxes to have that account all set up, right? And that goes into other costs. But a real quick backtrack here, because this is important. And it's really, like, if you learn nothing else today, know that when looking at loan estimates, here's the only 2 things you need to look at. What's the interest rate they're offering? 3.25%. Okay. What are the total lender fees in box A? $0. Now, not all our loan estimates look like this. We might have a quarter in points. Some lenders might have 10.55 in an underwriting fee. That's fine. But when you're doing a loan, you want to weigh the loan costs versus the savings. Somebody's going to show you a 2.99 versus this 3.25. But if that 2.99 has $9,400 in costs in this box A, the deal is much worse, right? $9,400 more here and saving $34 a month. It's going to take you 25 years for that to break even. So box A, total cost set by the lender, and the interest rate. Those are the 2 most important things to look at. All this other stuff, how much you're prepaying for tax and insurance, it's all going to be the same no matter what lender you work with. This is a good one to look at, total loan costs, because this accounts for box A plus B and C. And B and C is appraisal, title fees, and whatnot. So down in the bottom right of page 2 shows the breakdown of the loan amount. And then you've got total closing costs, which is, again, total loan costs plus all the other costs, all the setup of escrows and whatnot, to give you your final figures, right? And here's the payoff. The old lender was due $274,801 to get them paid off. So their $274 was paid off. $7,600 went into this loan, some on fees, some on prepaid property tax and homeowners insurance. Our new loan amount was $282,500. The borrower gets back $1,900. We're on our way. All right, another loan estimate. I just wanted to show one that was a cash out, just to give you some stuff on here. This is actually an investment property we did back in January. Oh, how we all wish that we could do cash out on investment property for a 3.25 interest rate. I'm sorry to report those days are gone, but rates are still low. So give us a holler. Conventional loan, yes, it's locked. We looked at that already. This will kind of be a review, which is cool. You're going to see all the same stuff and see if you learn anything in the first go around. Loan amount, interest rate, monthly principal and interest. This one is an example where the escrows aren't being paid, no and no, right? And so it's just the principal and interest payment. We're not worried about tax and insurance. Borrower's going to pay that on their own. Go to the bottom, $193,000 to the borrower. They've got $6,232 in loan costs and only $706 in other costs. In this case, it cost about 2 points for this client who wanted to buy down to this 3.25% interest rate. So that's going to show up here. Any buy downs for interest rate are going to show up in box A because it is a lender set charge. With the title, appraisal, and everything else, it shows us we got $6,200 in total costs on this side. Since we're not prepaying for any property tax or homeowners insurance, we've really only got recording fees, prepaid interest, and very little cost on that side. So anyhow, that's the loan estimate on a cash out refinance on an investment property. Hopefully you learned something there. Any questions at all, please feel free to reach out to me and my team. greatmortgagebroker.com, ping us. We are more than happy to help. Okay, refinance versus home equity line of credit. If you've got any questions, please feel free to ask them in the chat or ping us afterwards. We're more than happy to help. If you find me on YouTube, I try to answer all those questions on YouTube. There's 600 plus videos, so if it's on a newer video, it's more likely that I'm going to see it. As the channel grows and 80, 100,000 views a month and hundreds of comments, it gets harder. But I encourage you maybe to come check me out live. Mondays at 3 p.m. Pacific Standard Time. I'm live on YouTube. Just search Matt the Mortgage Guy, subscribe, allow notifications so you'll know when I'm going live on there, which I'm trying to do consistently so that you know when and where to find me. Anyhow, refinance versus Heloc. I preface with that because some of these questions are very, very specific. You might hear something that pertains to you, but you've got a little, caveat to your specific scenario. Refinance, like we've talked about, it could be rate and term, it could be cash out. Home equity line of credit is a whole different loan. And small banks and credit unions are generally the places who are advertising these home equity lines of credit. They do a great job at it. And truth be told, when somebody comes to me looking for a home equity line of credit, I refer it to a small community bank. So what is a home equity line of credit? Home equity line of credit is the bank saying, listen, you've got a bunch of equity. We feel good loaning you a little bit of money because you've got all this equity. You owe $300,000 on this house, but the house is worth $500,000. We are willing to give a home equity line of credit up to an 80% combined loan to value. And I'll explain it in numbers, so hopefully it makes sense. The $300,000 you owe on your first, plus a $100,000 line of credit, this home equity line of credit, is $400,000 total. That $400,000 total is 80% of the value of your house, which is $500,000. Most of the Heloc lenders are going to limit you at that 80% loan to value. So if you've got a home that's worth X and you owe 50% of that or 60% of that, you're going to have some room to take out a home equity line of credit if it's what works for you, if it's what's your best bet. Cash out refinance works relatively similar, except for rather than have your first mortgage and have the home equity line separate, you do a cash out, get this cash, one whole new loan, and that $400,000 is all owed to the same bank or the same whoever the broker brokered the loan to, right? Both have their pros and cons, and I'm going to go over those. Different stuff in different scenarios is going to make sense, right? Let's see what we got here. Is that where we went? The myths? All right, let's go back. Let's go back so we can talk about the pros and the cons of refinance versus Heloc. This is my opinion. So again, not a financial advisor, but this is just me, Matt the Mortgage Guy speaking, a guy who owns a few mortgages, knows a thing or two about finance. I actually got a finance degree. I forget that sometimes. A cash out refinance. If you're able to better your rate or lower your rate and do a cash out refinance and have it all be on a 30-year fixed rate loan, I think it's a great idea. Where you might lean towards a HELOC is a lot of people are in this scenario right now where they've got a 2.625, a 2.75 30-year fixed on their first mortgage. They want $30,000 because they need to get a new roof, and roofs are expensive nowadays, right? They got $6,000 in credit card debt, and they got a bid for the roof. It's going to cost 24 grand. Let's pay off the credit card. Let's do the new roof. We got all this equity. Let's use it. If you've got a 2.625 on your first mortgage, you would not want to do a cash out refinance to pull 30,000 in equity and have that new rate be 5%. It just doesn't make sense, right? Your payment's going to go up a lot on the whole balance, not just the 30 you're taking, but on the whole balance, you're going to be paying 5% versus 2.625, leave alone on the first, go get a home equity line for 30,000. The cons of a home equity line is that it's an adjustable rate a lot of the times. For some people, that's scary, right? I don't want an adjustable rate. One, look into some fixed rate options, which home equity line fixed rate options are available, or have a plan, right? We're going to do this, but with that $6,000 in credit card debt we paid off, we're going to have about a $600, cash flow per month of bills we're not paying. That plus another, $400, we're going to pay $1,000 a month. We're going to get this 30,000 paid off in 30 months. Okay, great. It might have an introductory term where it's a 2.99 rate, and then it adjusts every 6 months. By the time you have it paid off, it'll still be sub 4%. That's a good plan. That's a good case for a HELOC. Where a refinance is going to make more sense is you've got a 5.25%, you've got mortgage insurance. You've increased your credit score, you've got a ton of equity, and you want to look at a cash out refinance because you're going to stay put where you're at, but 50,000 to get this house where you want it to be. Okay, well, if you can refinance, pull cash out, go to 4.99%, remove the mortgage insurance, you might have a payment that's similar or only slightly more because you're lowering the rate, you're removing the mortgage insurance, you're taking the 50,000 out to do the remodel. That makes sense, right? So I could go on and on about scenarios. Generally, I think the larger amounts, I lean towards refinance as long as the first mortgage isn't super low. The smaller amounts, 10, 15, 20,000, 30,000, that's usually a HELOC. The fees are lower. If you have a plan to pay it off, the adjustable rate is less of a big deal, but really this is like a lot of things mortgage. Specific scenario to find out whether or not it makes sense, right? But pros and cons wise, 30-year fixed on a vast majority of refinance products, some ARMs on the home equity line product. Being in a low term on your current mortgage makes you less apt to want to cash out refinance and raise the rate. And then on the HELOC side, you're going to have limitations as well. But let us know if we can help. There's a million different scenarios I could go through, and my head is spinning just thinking about all of them. All right, let's debunk the mortgage myths. I tried to think of a few different ones that I see quite often. First and foremost, people are like, you never want to refinance. It's the worst idea in the world. You're starting over. Why would you want to start over? Everybody knows that over time, more goes towards principal as you pay the thing down. Everybody knows if you keep refinancing, you're going to owe, on this loan for 80 years. Well, what if you have a 4.99% interest rate 2 years ago and you had 28 years left on the loan? You could refinance it to a 2.75 and do a 28-year loan. We did a lot of those, 2020 and 2021. I've got lenders that will do a 28-year loan, a 24-year loan, a 19, a 17, a 14, whatever the case may be. You don't have to start over. Even when you do, I can show you examples of where somebody started over, got into a 30-year, they were going to save $330 a month. We strategically went to 30-year rather than 28 to give them some flexibility. If they took the $330 they saved and put it towards principal every month, they would have this thing paid off in 22 years. So they actually shortened their term by 6 years if they continue to make the same payment. The beauty of it was if things change, if you add a child, if somebody's going to college, If you run into tough times and you get cut from full-time to part-time, you have the ability to make the smaller payment, right? And so that's where a lot of people on these really low rate mortgage cycles that we've seen opted for the 30-year. They have an option. There's no prepayment penalty. Pay more, pay it off sooner, great. But if you run into tough times where you can't make that extra $330, extra $500, extra $800 payment, go ahead, relax, make your minimum payment, right? So anyhow, you don't have to start over. Some do, some choose to. Some want to go down to 15 years. You can do that as well. I could go on and on and on, but I won't. Just know you don't have to start over. All right, property tax increases. People are afraid of this. If you buy a new home in California, and this is different everywhere, so I may be speaking specifically to Californians. Some states will be the same, some different. If you buy a new home, taxes get assessed on the sales price. So if I go buy a house at $500,000, taxes are going to be roughly 1.25%, right? So I'm going to pay roughly $6,000 a year or $500 a month in property taxes. I can live in this house and it could go up in value to $1 million, $1.1 million, $1.2 million. It's only going to increase slightly because we've got a proposition in place in California where it can't increase too much year over year. I know some people that pay $500 a year in property taxes for houses that are worth $500,000. It's because they've been essentially grandfathered in, right? When we go to refinance, someone goes, you know what? I'm not going to refinance, man. I don't want my property taxes to get reassessed. Good news, they won't. Reassessment only happens on a sale. When you're refinancing your own mortgage and staying in your name, there's no sale happening. There's no transfer of ownership, no property tax increase. So that's a myth, debunked. All right. Lastly, it's expensive. Doesn't have to be. And in the case I showed you earlier, way back when I went over the first loan estimate, I showed you a client who we took from, I believe, in the high fours with mortgage insurance to a 3.25. And that was with zero lender fees. You saw box A, there was zero lender fees, nothing, nada. And we even saw 2137. You know what I should do? With the risk of getting lost, I'm going to scroll back through here because I remember this loan. 2137. Total fees. This is a little bit grayed out, but in box B, there's a $700 charge for an appraisal. We got an appraisal waiver, meaning we didn't need the appraisal. On the final settlement statement, the $700 disappeared. We didn't need an appraisal. So $1,437 in total fees. The high fours to 3.25 wiping out mortgage insurance. I don't remember the exact figure, but maybe we saved them $300 a month. So you take that $1,400 number of cost, that was the total cost of the loan, total loan costs. That's not expensive, especially when you're saving $300 a month. Literally pays for itself within 4 or 5 months, then you are free rolling and it's all good from there. All right, hopefully this was helpful. If anybody has any questions, pop them in the comments. We'll try to answer those before we get off. Just another quick reminder that, I'm not a financial advisor. I'm just a guy on YouTube. Today, I'm just a guy on Zoom. It was my pleasure representing U Mortgage, bringing financial literacy to everybody. We'll pop into some Q&A, but thank you for your time. Hope you learned something. If you want to reach out to me and the team at mtmg.com or go to greatmortgagebroker.com. Let us know where you're at, how we can help, and we'll be in contact soon. Okay, questions and answers. If there's any that popped up, Ryan, you just ping me, let me know, and be happy to answer them.
Yeah, Matt, a few questions did come in message to me. So the first one here, will refinancing change my credit score? Will it have an impact?
It won't, in the sense that you've got good payment history and you've got a balance on the old one, and now you've got the balance on the new. The positive impact you can have on your credit score is whenever somebody does any sort of debt consolidation through a refinance, like a humongous portion of your credit score, a third of your credit score is debt utilization. And so if you've got 10, 20,000 in total like limits on your credit cards, and you're running those up to 9,900 or 19,800 against those limits, that is going to drag your score down like crazy. I've seen people do a cash out refinance, pay off those balances, and see a 60, 80, 100 point increase. But just the act of refinancing, there's nothing that's going to be triggered on your credit report that has any sort of, truth be told, negative or positive impact.
That's great, Matt. Thanks for clearing that up. And the second question that came in, is there a limit to how many times I can refinance?
There's not a limit, but what I do tell people, and really, like, I don't think this question was ever posed before 20 and 21. Like those last 2 years where you could do a refinance 1 month and go from 499 down to 375, and then you look up 4 months later, like, oh my gosh, now I can get it 299. Lenders generally want you to wait 6 months before you refinance into a new loan. But as a consumer, you want to make sure you're refinancing for the right reasons. If you're refinancing because you want to skip 2 payments, wrong answer. If you're refinancing because you want an immediate influx of cash with no thought of how this is affecting your financial future or your monthly payment or anything like that, wrong answer, right? And so, talk to a mortgage advisor that's going to give you true advice. The thing about it is, if you talk to a mortgage advisor that tells you, hey, listen, this doesn't make sense and here's why, you can usually take that advice to the bank, because mortgage brokers, mortgage bankers, mortgage everybody, we get paid by closing loans. So all the people that came to me and I said, it doesn't make sense, don't do a loan, know that I spoke from my heart, because I get paid by doing loans. By telling you that it doesn't make sense, I'm essentially saying, no thanks to the paycheck. I think you're better advised to stay put, right? And that's what good mortgage advisors should do.
Yeah, that's really good. Thanks, Matt. That's all the questions we have coming in now. As Matt said, there's a few ways to get in contact with him, following the YouTube channel, his website. Those things still exist if questions do come up. We still have a few minutes left. If questions do come up, use the Q&A and use the chat here as well. But Matt, any closing remarks to wrap us up?
Not really, except for that, I think I'm passionate about homeownership. I'm passionate about financial literacy for the consumers. So, as a consumer, if you're watching this, if, you're thinking about refinance, which was the topic of the day, make sure you're talking to a trusted advisor. Make sure that you're really, thinking it through and setting yourself up for, success, because the statistics show that a homeowner versus a renter, the net worth is like 45x for a homeowner, right? With that being said, it's because over time you're paying off your mortgage and the house is going up in value. During the course of that home ownership, whether it's 30 years, 40 years, 50 years, you can do a lot of great things with the equity. You can pull out equity and buy an investment property. You can pull out equity and start a business. You could pull out equity and pay off credit card debts, redeploy that towards paying down your mortgage and pay off your mortgage faster. There's good quality things you can do with that equity that will help you in the long term. But like, most people will use the chainsaw analogy. It's a great tool, right? But if it's used incorrectly, you could cut your arm off. And so, debt in this case is a great tool that you can use to your advantage, do a lot of great things, but it's also dangerous. So make sure that you're talking to somebody. I'm a professional chainsaw operator. I will help you not cut off your arm. I will help you use it to just cut down the tree and make, a beautiful, clear backyard where you can stare off into the sunset.
Yeah, Matt, I really appreciate, just you running this session and giving people that frame of mind to think about how refinancing can benefit them, and really weighing out the pros and cons and framing that out for people, I think is, really powerful. So one, thank you for joining us today. It was truly a pleasure to have you on Financial Literacy Week. And just bringing your expertise here has just been such a huge boost for our week here. I'd like to thank everybody who joined the sessions and the sessions all week. It has been a phenomenal thing. I hope you gained a lot from this, and there's still a lot to come. If you watch the session, you're like, hey, my family member, my friend, they should have watched this. Well, they can do that. We're going to be doing a lot of replays over the weekend. And as Matt talked about, we're going to be doing replays on like cryptocurrencies, debt, income, financial planning. So it's not too late to register, even though we're getting close to the end of the week. You can still go to umortgage.com/financial literacy week and go and get registered and get the access to all these sessions. So there's still a lot more in store for our last 2 days. We hope to see you there. I'd like to thank Matt one more time for being here. It was such a great session. Thank you all for joining, and have a great rest of your Friday, and we hope to see you back this weekend.
Cool. Yeah. Just in closing too, I want to let people know I'm not going anywhere, right? Go find me on social, Matt the Mortgage Guy, whether it's Instagram or YouTube or TikTok. Happy to answer your questions. I'm going to be doing this for quite some time. So if you want good, honest answers about mortgage, whether it's refinance or purchase, please feel free to reach out, ping me on social, go to greatmortgagebroker.com, and hopefully this was helpful. Thanks again for joining, guys.
Yeah, thank you, and have a great night, everyone.